Good evening, and welcome to the AlgoIndex market close for Monday, July 13th. Here is the bottom line. An overnight oil shock and hawkish policy talk hit risk appetite. The S&P opened at its high and sold off all day, and it closed at 7,515, down 0.8%, sitting right on top of its dealer gamma flip level. And here is the part your screen did not show you. This was not a headline flush that bounced. It was steady, deliberate selling. About $7 billion of index-level, dealer hedging flow dragging the market lower into the close, as institutions unwound long exposure and bought protection ahead of tomorrow morning's inflation print. The Nasdaq 100 fell about 1.7%. Chips led the way down with one Korean memory name off 9%, and the volatility index jumped 14% to close at 17. Coming up in the next few minutes, the exact levels that now decide this market. The gamma flip line at 7474, and the volatility inflection level at 7495. The $7 billion hedging flow and what it was actually made of. The smart money bet of the day, which on a red day was a lonely one. The single most extreme bullish position in the market, pointed at Brazil, while everyone else bought insurance. And our own desk, which read this one correctly and finished 2-0. Here is the closing scoreboard. The S&P 500 settled at 7,515, down 0.8%, inside a tight 78 basis point range, and it closed near the low end of that range, not the high. The Nasdaq 100 was the laggard, down about 1.7%, dragged by a chip sell-off. One Korean memory name fell 9%, and the semiconductor group dropped about 4%. The one green corner of the market was energy, as crude oil spiked about 6% on the overnight geopolitical news. The volatility index closed at 17.15, up 14%, and its own volatility gauge finished near 95, up 9%. So demand for protection was rising into the close, not fading. Two numbers framed tomorrow. Options are still moderately priced. Implied volatility on the index sits near 14%, with an implied volatility rank of about 21. But the options market is now pricing tomorrow's move at 17% implied, about 106 basis points in either direction, because the inflation print lands at 8:30 in the morning. So what actually drove it? Three things, each with a number. First, the shock. Overnight, a geopolitical escalation and an oil spike lifted crude about 6% and sent the volatility gauges up double digits before the bell. And stocks never recovered. The S&P opened at its session high of 7,565 in the first 5 minutes and spent the entire day grinding lower to a 1540 low of 7,506. Second, and this is the part you could not see, the flow that sold it. Index-level dealer hedging flow ran about -$7 billion on the session, and it touched -$9 billion intraday before a small close bounce. And here is the composition that matters. It was roughly $3.5 billion of longer-dated call selling, plus $3.5 billion of longer-dated put buying. Read that together, and it is one trade, institutions unwinding upside and paying for downside, hedging into the inflation data. Across single stocks, dealer flow was another -$3 billion. Third, the structure. The whole market now sits on a knife edge. The index closed at 7,515, just above its volatility inflection level, at 7,495, and its dealer gamma flip level at 7,474. And below that flip line, dealer hedging stops cushioning and starts amplifying. Positioning overall was net short by about $10 billion of index and exchange-traded fund delta, with put buying the dominant force all day. Now the levels walked against the real session. The S&P opened right at its high, 7,565, in the first 5 minutes, and that was the last good moment for the bulls. From there, it was a one-way grind, lower highs into the afternoon, a session low of 7,506 at 15:30-40, and a close at 7,515 that could not get back above the round 7,520 shelf. Here is the map that matters now, top to bottom. Overhead, resistance stacks at 7,560, then 7,575, then the gamma ceiling and primary call resistance at 7,600, which is also the marked top into Friday. Below the market, the near-term battle is a narrow band, 7,520 first, then 7,500, a heavy support and gamma concentration strike, where the highest probability magnets sit near 7,507. Under that, the two lines that decide the character of this market, the volatility inflection level at 7,495 and the dealer gamma flip level at 7,474. Lose 7,495 and 7,474 on a close, and the same hedging flow that gently bled the market today can turn into a faster slide. The next real shelf beneath is 7,450, then 7,400, and the deep put support sits all the way down at 7,300. Here is where the real money went, and today it is a mirror image of a normal up day. Start with the lonely bull. On a day where almost everything was being sold, the single most extreme single-name flow in the entire market pointed one way, up. And it was Brazil. The Brazilian Equity Exchange Traded Fund printed a bullish delta reading in the 99.9th percentile of its own history. It was the only statistically extreme position of the day, a clear bet by someone that Brazil keeps climbing, while the rest of the world hedges. Now the other side, which was almost everyone else. The hedges were loud and specific. Institutions bought more than 12,000 volatility crash calls struck at 95, a bet on a genuine volatility spike. And they added roughly 28,000 index puts in the 728 and 732 strikes into this Friday's expiration. Stack that on top of the $3.5 billion of longer-dated index put buying in the broad flow, and the barbell is the opposite of a greedy market. One bold, isolated bull bet on Brazil, financed against a wall of index and volatility protection, bought into the inflation print. When the smart money is paying up for insurance the day before the data. One more read for the options traders. Volatility woke up today. The volatility index jumped 14% to 17, its own volatility gauge rose 9% to 95, and fixed strike volatility rose between 1.5 and 7 points across the board. All of it, demand for hedges. Even so, the raw level of implied volatility is only moderate, near 14% with a rank around 21, which tells you the market is repricing risk quickly, but is not yet in a panic. The sentiment tilt was clearly defensive. The put-to-call volume ratio on the index printed about 1.4. The 1-month implied correlation is still sitting near 2-year lows, and the 25 delta skew is tilted for downside. The actionable line. With the inflation print at 8:30 tomorrow and the index resting right on its gamma flip level, the options market is already paying up for a move, so this is a moment to respect position size, not to chase the first candle. And here is our desk, the honest version. And today the honesty is good news. Our systems traded twice and finished 2-0, both winners, and both were the same idea: fade the rallies. The first was a short side setup on the S&P that entered near 7,583 and covered near 7,572. The second was our AI options long put that entered near 7,598 and worked down to 7,586. Both were single-leg defined risk trades that leaned the way the flow was leaning, short into strength, on a day when every bounce was a selling opportunity. We are not going to pretend every day looks like this, but when the price action, the flow, and the structure all point the same direction, the discipline is simple. Take the trade the market is handing you, and do not fight the downtrend. Into tomorrow and the rest of the week, our bias is bearish with medium confidence, and here is the reasoning. Price closed weak, near the low of the day, and right on its gamma flip line. Momentum rolled over, and the smart money spent the whole session buying protection rather than dips. But the reason it is medium confidence and not high is the calendar, because tomorrow is a genuine swing event. The inflation print lands at 8:30 in the morning, with a Fed chair testimony at 10, and the options market is already pricing a 106 basis point move. A cool number could easily squeeze this back towards 7,560 and 7,575, while a hot number is what the hedgers are paying for. The rest of the week keeps the pressure on. Producer prices and the first big chip equipment earnings Wednesday, a major foundry Thursday, and monthly options expiration Friday. The map is simple. Overhead, 7,560, then 7,575, then the 7,600 ceiling. Below, the two lines that matter, 7,495 and the 7,474 gamma flip. Then 7,450 and 7,400. What would flip our bias back to constructive? A cool inflation print and a close back above 7,560. What confirms the bears? A sustained loss of 7,474, where dealer hedging turns from cushioning to amplifying. That is your market close for Monday, July 13th. If this helped, the best next step is our free AI trading journal at members.algoindex.com. Check our gamma level accuracy tool and the full write-ups on the blog at AlgoIndex.com, and join the community on Discord. We are back same time tomorrow, right after the inflation print. Trade well and stay disciplined.